The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Yesterday's AI skepticism flipping today to AI optimism, live, seated from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off the closing bell here in the United States from our chairs. Let's take a look at the S&P 500. Higher by about 0.7%. Certainly a bounce back from what we've gotten used to, but certainly off the highs that we saw just today. We had a session high of 1.4%. Some of that momentum draining, but you can see we're still looking at a big gain when it comes to big tech. The Nasdaq 100 higher by about 1.3%, all as a rally builds in the bond market. We did get that softer than expected CPI this morning. 10-year yields down about 4 basis points. And the VIX, volatility in your equity market draining a little bit today. The VIX trading with a 17 handle.
Yeah, you alluded to two of the big boosts, at least for equities on the day. That comes from the surprisingly strong forecast from memory chip maker Micron and a surprisingly benign consumer inflation report out of the government. The November inflation undershoot with core price growth coming in at the slowest one-off reading since 2021, likely packing a bigger punch as the report is seen as tilting the balance of argument at the Fed towards another rate cut in late January. But not everyone is convinced. Pricing in the swaps market show rate cut odds haven't materially increased, at least not today. And that 6 basis point knee-jerk reaction drop that we saw in the 2-year yield after the report at 8:30, well, that's all but been erased by 11:30, a reversal that suggests investors still want to see maybe just a little bit more data to help round out the economic picture. Now, with or without that picture, though, the market can still hold some faith in corporate earnings, which are seen maintaining that current trajectory above historical average. Micron's beat last night, Darden's upside guidance this morning, and improving expectations around reports from Nike and FedEx tonight. In fact, 2026 estimates for aggregate earnings from S&P companies, they've been climbing for months now, and now imply year-over-year earnings growth of 12% plus this year, inching up to 13% next and 14% in 2027.
We're going to end the year at around 13% in corporate earnings. And as we all know, we've had all-time highs on the S&P, the Nasdaq, all of the above. The idea that that will carry into 26 is pretty important.
And Katie, that really is sort of the mix that we're seeing right here on this Thursday afternoon.
Yeah, and I wanted to take a quick look at the bond market because we talk about earnings, but we know that the 10-year Treasury yield and just the direction of where yields are going in general certainly informs the enthusiasm in the equity market. Bond volatility actually at a multi-year low rate now when measured by the Move Volatility Index. You're looking at a 4-year low or thereabouts. And you can see that even though it feels like it's been pretty turbulent when it comes to the bond market this year, it's just been a steady grind lower. We did have that pickup around April, but since then, the trend is clear. Bond volatility coming down. You could say the same about the equity market as well.
All right, let's kick things off with Gargi Chaudhuri, head of an iShares investment strategy of the Americas over at Blackrock. And Gargi, I do want to kick off here with kind of the interplay between what we're seeing in the stock market and the bond market, and whether they are actually singing from the same hymnal right now, or if there is a divergence we should be paying closer attention to.
Good afternoon, Katie and Romaine. It's wonderful to be here. Happy holidays to you and your listeners. So not just today in terms of stock and bond markets, but if you look at the price action for the entirety of 2025, your wrapped list, if you will, I think that they have both been singing from the same hymn book, if you will. Two of the things that we have been paying attention to is what is driving equity markets has been very much around earnings growth, and what has been driving bond markets, and especially around the lower volatility that you just pointed to in the bond markets, has been around the Fed delivering what is expected from them and the Treasury delivering what is expected from them, and really with that taking a little bit of volatility out of the markets. And that's exactly what we have got, both those asset classes as well as many of the diversifiers that we have in our portfolios ending the year on a positive note.
With regards to portfolio positioning going into 2026, Gargi, do you at all worry about inflation, particularly against the backdrop of the report that we got earlier today, which seems to suggest the trajectory is still disinflationary, potentially here? Does that mean you adjust your portfolio for a less inflationary environment?
Sure thing, and we're actually in the midst of writing our year ahead right now. It's going to come out on Jan 6, so I'd love to come back to discuss more of that. But maybe three things that we're thinking and writing about in our team. The first is just this gradual deceleration. So not today's print particularly, because we do know that there tends to be a little bit of noise given the shutdown, et cetera, impacting the number, but that it is directionally consistent. So whether or not you believe every single line item, it is directionally consistent with the year-over-year print of the November, lower than what we had seen in July and August, et cetera. So that itself is allowing for the Fed to continue to perhaps deliver 2 rate cuts for sure. That is our expectation. So again, making income really, really valuable in a portfolio context. At the same time, another fact that we're thinking about is just this idea that, going into 2026, there are many positive impulses for growth.
Right.
So with respect to where we end Q4 versus where we begin Q1, that positive impulse for growth may also aid that earnings growth across a broader swath of industries, not just tech and AI. And then the third thing is just what you said around portfolio construction. I think you still need different types of diversifiers because of some of the fuller valuations in many different asset classes.
Gargi, let's talk about income a little bit more, because for the past several years, getting income was as easy as just piling into a money market fund. But how does that become redefine that hunt for income in an environment where the Fed is easing?
Absolutely. It's such a great question, Katie, because we've obviously seen a lot of investors buying SGov, which is really that very front end of the fixed income market. And you were able to pile some cash in there because of the yield that was available to you when the Fed kept interest rates more elevated. With that coming down and expected to come down further, you really need to be more deliberate in your income bucket and think about sourcing income from fixed income, of course. So again, allocations to ETF, active ETFs like BINC, which gives you that multi-asset securitized emerging markets, but also looking at equity income as a source of income. And then the last thing I'd say is looking at dividend income as a source of income and private credit as a source of income. So the combination of those 4 in a portfolio as equity, fixed income, or diversifiers to allocate to income in a lower Fed regime in the months ahead.
Well, BINC there of Rick Reeder fame. I do want to talk a little bit more about fixed income ETFs, because I do think it's striking that when you take a look at BlackRock's own ETF lineup in the fixed income space, in terms of what's losing money, your biggest year-to-date losses are in TLT. That is 20-year plus Treasuries losing about $3 billion. You take a look at the flip side, as you mentioned, it's SCUB, just a staggering $37 billion of inflows. That, of course, is 0 to 3-month Treasuries. And I feel like that tells the whole story. People piling into shorter dated debt and basically saying, get me out of the long end. Gargi, when do we start to see people maybe step out the curve a little bit?
Yeah, and I think we're beginning to see that a little bit already. So yes, you mentioned SGov, but some of the other asset classes that have also been gathering inflows are more of those multi-sector fixed income ETFs. And actually, if you look at active fixed income ETFs, about 38% of that total inflow. And thinking about, as you said, categories like BINC, but also, frankly, categories like the ag, just the simple pure ag that might be a little bit more exciting than it was just a few months ago, or more active versions of the ag. And we're talking a lot about our systematic bond fund, the SISB, which we think is, again, going to gather a lot of inflows in the year ahead because, again, investors are looking to harness income in their portfolios, looking to move away from the very front end and find opportunities for that all-in yield at a time when you might not be able to get that in the very front end.
Gargi, always a pleasure, always so smart. Gargi Chaudhuri, head of iShares Investment Strategy over at BlackRock. Coming up here on the big program as we count you down to the close, a closer look at the state of the economy and how the Fed may react to it. A conversation with BNY Investments Chief Economist Vincent Reinhart.
And plus, a closer look at what's driving the markets beyond the Federal Reserve with Paul Abrahimzadeh. He is partner over at 1789 Capital. We'll discuss the opportunities within AI and tech, including the company's investment in SpaceX ahead of a potential IPO.
Well, this isn't quite space, but if you are taken to the friendly skies and you can afford it, well, you might know our next guest. A conversation up ahead with Alan Walsh over at Sentient to talk a little bit more about what high net worth individuals are doing with regards to their own personal travel. All that and more coming up here in just a second, right here on The Close. This is Bloomberg.
Core U.S. consumer prices rose at the slowest annual rate since 2021 in November, based on this morning's long-awaited CPI report. The market now pricing in slightly more rate cuts in 2026 on the back of that data. Joining us to unpack that report is Vincent Reinhart. He is chief economist over at BNY Investments. Great to have you with us, Vincent. So a lot of questions about the quality of this data. Of course, we know that it was impacted by the government shutdown in terms of collection. So when you take a look at the figures that you got at 8:30 this morning, how big is the asterisk next to it?
Well, I think Bloomberg ran with the headline, the Swiss cheese report, and I think that's right. We lost something by not having BLS survey takers in the field in October. And so we just don't know what happened. And there's a bit of smoothing through the 2 months. What I see is essentially 2 months worth of sluggish further progress in disinflation for the Fed. The sticky prices, services, things that are tied with contracts, they lost about 1/10 or so over the last 2 months in terms of their inflation rate. And then we got a bonus that more flexible prices, commodity and goods prices, their inflation rates slowed more because oil prices have fallen.
So a lot of nuances here. The Swiss cheese report, as you mentioned, a lot of holes here. But that being said, to your point, it shows good progress here, at least some progress when it comes to slowing inflation. With that in mind, do you think it's the correct interpretation by traders to price in slightly more easing when it comes to next year?
No. I think what the last 2 days was validate the Fed's decision back in September to buy 3/4 percentage points worth of insurance by cutting by a quarter at the last 3 meetings. What it says is the Fed's in the right place now to respond to news. It doesn't tell us what that news will be. And so I think we got to be a little more even-handed on expecting what the Fed will do in 2026.
There are a lot of questions, though, Vince, over the next 5 months as we kind of wait out the end of Powell's term and the potential announcement in a matter of weeks from the president as to who would actually replace Powell. What do the conversations look like at those next 3 meetings, though? I mean, is Powell really going to be the one guiding this ship, or is it going to be maybe a little bit more, of a free-for-all, for lack of a better term?
Well, I think the December intermeeting period gave you a little bit of a signal. The chair only has 1 vote, but he or she can exercise the soft power associated with the job, i.e. make promises about the future wording of statements, and can threaten about what assignment you might have or whether or not they'll go to your research conference if you're a Reserve Bank president. That exercise of soft power is what brings the committee together. However, it's got a sell-by date. Chair Powell can't make promises too far into the future. And so he loses some of his traction on the committee. I also think you look at the last couple months, and Chair Powell is really preparing his colleagues for his successor. What did he do? Over the intermeeting period, he was very quiet. He let them talk. He let them get the media attention. He tolerated dissents, 3 dissents at the meeting. Didn't really work hard to corral those dissenting colleagues. They at the board level, they voted several months in advance on the roster of bank presidents, And at the FOMC level, they started reserve management purchases of Treasuries well in advance of what a lot of people thought.
Yeah.
What was he doing? He was getting the institution ready.
Yeah, and you kind of see that playing out. I am curious then, too. So as we get into next year, Vince, do you think we're going to get, I guess, more reliable data for the Fed to depend on that, whatever disruptions we had from the pandemic, from the shutdown, that'll be resolved, and that as we get into that late January meeting and hopefully for the meetings after that, it will be a cleaner read of the economy?
So are you predicting no more government shutdowns in 2026? Don't be that confident. I think we're gonna get past the hole in the Swiss cheese of October, but that contaminates the panel. And for the household survey, the BLS does this rolling switch of the panel, and there's a hole there you can't fill. So it'll take a while before we can trust the data. And there are a lot of open slots in the statistical gathering agencies, and so you gotta worry about leadership. But we'll get past it. We'll have more confidence about the data. But we're at an inflection point. Will growth still be a trend? Is inflation still going to go lower? Inflection points are tough to predict.
Yeah. All right, Vincent, we have to leave it there. But really nice to wrap up here. And I assume this will probably be the last time we talk to you before the end of the year. So have happy holidays. We'll catch up with you in January. Vincent Reinhart there, who spent a couple decades at the Federal Reserve, now a chief economist over at BNY Investments. When we come back after the break, we're going to talk Olive Garden, the parent company, Darden. The shares up on the back of its earnings. And they had some really interesting things to say about the health of the consumer. Some interesting things that seem to defy some of the doom and gloom that we heard earlier in the year. That's coming up next year on The Close. This is Bloomberg. All right, time now for our top calls. Big movers, back of analyst recommendations. And we start today with Rivian. Baird upgrading the EV car maker to outperform and increasing the price target to a street high, matching $25. The analyst says the 2026 launch of Rivian's R2 model will expand the company's lineup into a lower price category that should significantly increase its total addressable market. Those shares up 13% on the day. Next up, Lennar. Evercore ISI cutting to underperform. The price target slashed to 92 from 114. The downgrade coming in the wake of the home builders' disappointing earnings. And the analyst says there could be further downside risk. Those shares down for a third straight day. And finally, Shake Shack. JP Morgan upgrading to neutral, setting a price target of $90. The more than 30% drop in the stock since July makes the stock a lot more attractive, according to that analyst. The shares getting a nice bid on the day for a second straight day at 86.08. And those are some of our top calls. We do want to stay in the restaurant space and take a closer look at Darden. This, of course, is the owner of Olive Garden and Capitol Grill, seeing better than expected growth in the most recent quarter. And that was boosted by strong spending from middle and high income diners. Nick Setyan joins us right now, managing director and research analyst over at Mizuho Securities. And Nick, I want to unpack that, sort of like what type of consumer are we seeing walk in those doors? Because earlier this year, all the talk seemed to be that some of these dining establishments, at least kind of these mass market, kind of semi-casual places, weren't doing well because those middle income consumers weren't spending. What's going on?
Hey, thanks for having me, Romaine. I think, ultimately a lot of restaurants have taken too much pricing, and there's some restaurants that have taken less pricing than even grocery. And if you look at casual dining as a segment, and Olive Garden is no exception, they've actually taken pricing in line to even below grocery over the past 5 years. And they've done a great job of highlighting that check compression relative to QSR. And so across casual dining, we've seen traffic trends that are positive, and the segment has outperformed, led by Darden, the rest of the industry, including fast casual and QSR.
How are they doing with regards to maintaining costs or managing them, particularly with some of the elevation we've seen in commodity prices, particularly in beef?
So, given the fact that they own Longhorn, their exposure to beef, along with their fine dining, businesses like Capitol Grill and Ruth's Chris, their exposure to beef is higher, and that is driving outsized inflation. That's the reason we saw margin miss despite the top line upside in the quarter, and that's the reason why they maintained EPS guidance despite raising same-store sales guidance. Hopefully, the headwind from beef inflation decelerates in 2026, but it's a very long cycle. So that inflationary headwind can be with us for a while, even at a lower pace.
It was also interesting to see the reception to smaller portions. As we know in our Bloomberg News story that specifically Olive Garden has been rolling out smaller portioned, lower priced options, trying to play to that affordability sort of vibe out there right now. We know that has backfired in some of the, more fast casual lunch spots, but it seems to be bearing fruit at Olive Garden.
That's another trend we're seeing across casual dining. And I think the lower entree sizes is a move to, again, appeal to that lower income customer who is hyper focused on value. And I think the casual dining segment, again, led by Olive Garden, is very well positioned to make those types of moves, to go after that customer and hopefully sustain the positive traffic that we've seen across the segment and at Olive Garden.
And when it comes to retail, Nick, something we often talk about is the idea of this trade down trade, if you will, that basically when things feel stretched, when inflation is stubborn as it is right now, that you see people maybe go for lower priced options. Does that exist in the restaurant industry? Can you apply that to what we're seeing in some of these Darden restaurant brands?
Well, it certainly exists. And ironically, what we're seeing is because casual dining has kept its average check growth relatively suppressed, and that's relative to fast casual and QSR, we're actually seeing switch from what we would have seen historically, a trade down to those categories. We're actually seeing a switch to casual dining from, say, fast casual and QSR. Like Chili's, for example, is highlighting their $10.99 burger, and they're directly going after the Big Mac on national television. And that's a message that's resonating with customers, and that's acted as a halo across the entire segment, and Olive Garden's benefiting as well.
All right, Nick, always appreciate your insights here. A great day to a certain extent when it comes to what we're seeing out of Darden. And of course, obviously, a lot of folks really looking at the broader restaurant landscape for any clues that we can glean from that report. Nick Setyan, Managing Director and Research Analyst over at Mizuho Securities. And Katie, I mean, we talked a lot about that all year long, how a lot of these sort of casual dining places said we're really kind of being squeezed, right? The high-end diners, they were going to the high-end places. Lower-end diners were going to fast food, and middle-income diners were just staying at home, more or less.
Yeah, and it's interesting to see Darden, dispel that to some extent. Again, I do think it's really interesting that, Olive Garden, it seems to be working for them, offering smaller portions at lower prices.
Yeah.
I feel like that can only go so far before diners start to revolt a little bit.
I don't know. I'm actually in favor of smaller. I feel like sometimes portions in restaurants are way too big.
This is America.
Because, okay, but then you pay for that, Katie.
That's
so
true.
If the trade-off is you give me a smaller portion that I can actually finish in one meal.
Yeah.
And give me a lower price point, I'm all for it.
These are fair points.
Now, I know you're a glutton. You just take the endless breadsticks over and over.
I want it piled high on the plate. Coming up, news of a potential SpaceX IPO, generating speculation about what it could change in terms of how the company operates. We'll discuss next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Keeping an eye on these markets, also looking ahead to 2026 and SpaceX topping OpenAI, Romaine, as the highest valued unlisted firm. That raises the potential for a 2026 IPO raise. And it is fun to speculate. I mean, what that would look like.
Yeah, and we kind of went down the rabbit hole earlier this week. We were talking about some of the biggest. Obviously, Saudi Aramco was the biggest. And you kind of look, okay, how was that digested? And let's just say it was a very small sliver that got peeled off there. And that was the only way you can get it done. And
exactly.
I assume SpaceX will probably look like something to that degree as well.
Yeah. So there is some precedent, but it's not apples to apples there. So let's continue.
Have you been to space?
I've never been to space, and I would never go.
No, never?
No, I belong on Earth. Joining us to discuss is Paul Abrahimzadeh. He is 1789 Capital Partner, which has invested in SpaceX. Paul, it's great to see you on set.
Great to have me back. Thank you.
So come into this conversation. We've been sort of doing the thought exercise of what this would look like. And I mean, to the point of Saudi Aramco, that's not quite an apples to apples situation. If we did see these mega companies come through, a SpaceX and OpenAI, how does that get digested in the IPO market?
Incredible depth of liquidity in the U.S. capital markets. So whether you think back to Aramco or Alibaba, two IPOs I was fortunate to work on, the Petrobras historic $70 billion capital raise back 15 years ago, you've got the ability to place considerable capital in the U.S. and abroad. When you're talking about SpaceX or OpenAI or Anthropic, these are going to be deca-billion-dollar IPOs, cent-a-billion-dollar market cap companies, maybe $1 trillion plus. And these are must-own N-of-1 companies with very strong global demand, very strong brand recognition, and incredible retail following when they're public companies. So we have no concern about market depth. I think it'll be a factor of structuring, timing, valuation that's really key.
Well, you call SpaceX a must-own company. It's a company that you own, of course. But talk us through, what that means. The idea that, when this goes public, if you're an institutional investor, it sounds like you just have to participate.
If you think about it, SpaceX or OpenAI or Anthropic will be in the S&P 500 12-month post going public. So it's part of your benchmark. You need to own it. It's a question of when you buy it. And there will be a lot of gamesmanship around the IPOs, and some people have pre-IPO exposure, given there's been material capital raising in the private market by all three of those companies. But again, these are must-own companies institutionally and retail, and they're going to move markets. So you're talking with SpaceX, a company that'll hurdle into the Mag 7 almost immediately once it's public. So we're incredibly excited. We think this is the year of companies going public. There's an incredible backlog. And we also think away from those companies, there's M&A activity emanating out of Silicon Valley that's going to be a real second catalyst to capital formation.
Just one more point, though, on the IPO thing and digesting IPOs of this size, because it's not just SpaceX. It's potentially we can get at least maybe 3 of those centicorns probably coming public. Do you need to space that out? Meaning, like, if one came and then another came a month later, would basically the first one dilute the second?
It's a great point. The reality is, the cadence is going to be very important, and you can't bring all of that paper to market at once. I think the fact of the matter is the market's been starved of IPO activities, you guys know, for the past 3 to 4 years, and there's a lot of excitement. So for appropriately priced, must-own large cap equities, I think there's going to be exceptional demand. To put that in perspective, you look at a company like Alibaba, when they went public, that was a 20 plus times oversubscribed $25 billion IPO. So again, getting back to that point, there's incredible depth of liquidity in the market to support these jumbo deals, but you're absolutely right, the cadence will be very important.
With regards to the M&A activity in the private space, is that going to be more a function of kind of, smaller or say mid-sized companies pairing up, or are we talking about big giants buying competitors or maybe just or up-and-comers, I should say? I
think the latter. I think when you look at the equity value of a lot of the fast-growing, pivoting to free cash flow unicorns in the private market, they're incredibly additive to some of these larger cap technology companies that are looking for the next leg of growth. Many of those large caps have had a great 2024 and 2025 organically, and I think inorganic growth is going to be a catalyst that propels them to continued new revenue scale in 2026 and 27. So, we think looking at the private market, you've had relatively quiet M&A. There have been 3 or 4 notable deals across the unicorn landscape. I think there's a lot more of that to come next year.
Interesting. Do you think that comes in any specific sector? Is there any specific industry that you have your eye on that seems ripe for consolidation?
Across the sectors where we invest, I think they are all fair game. I say that because, whether you look at the large language models, you've got some of them where I think acqui-hires are a possibility, where you've got a fantastic business, but again, even if it's a deca-billion-dollar price tag, it's still a drop in the bucket for some of these mega cap technology companies. Semi-compute's another area, defense tech. When you think about the disruption of the traditional primes, while the price tags aren't cheap on a multiple basis, on an absolute enterprise value, some of these companies are relatively small versus the incumbents. So I think you're going to get back to this paradigm we saw a decade ago of the disrupted acquiring the disruptors. And so beyond the IPO market reopening, we think that's a very important second catalyst on the come over the next 12 months.
Well, let's talk about some of the sectors that you do invest in. I'm taking a look at your portfolio companies. I see a lot of AI names, a lot of software names. You have some defense names in there as well. When you think about, what you hold right now, and you think about the different names in here, I see Databricks, for example. We spoke to the CEO a few days ago. Is the hope that, some of these companies in your portfolio right now do come to the public markets? Absolutely.
We look at our portfolio and roughly a third to 50% we think can be public in the next 12 to 24 months, credibly, based on their revenue scale, their path to profitability, their internal preparations. From our perspective, we're being very careful on the capital deployment. I think this is an incredible period of disruption. So when you look at the AI landscape broadly defined, we've got exposure that we're very proud of in companies like Crusoe from a digital infrastructure perspective. That industry's had a lot of focus in the last few weeks as you've seen CDS spreads widen in some of the large cap tech companies based on capex required to fund that build out, as well as large language models like Reflection AI that we co-led with both NVIDIA, DST, and others, which is endeavoring to be the leading open weight model in America to counterbalance DeepSeek and Qwen, where U.S. regulated industries need to build on an American open weight frontier model. There are other companies across AI like Cerebras and Grok, GROQ, that are going to be critically important as you think about challengers from a semi-compute hardware perspective. So we're making very calculated bets on behalf of our limited partners across that landscape, but always looking at disruption risk and a path to liquidity.
We had showed a graphic earlier about the percentage of companies in your portfolio that are AI native or at least AI enabled or something. I forgot the exact phrasing. But give me a sense as to how you sort of separate the wheat from the chaff, because I'm sure you know this. I mean, there are a lot of companies pitching themselves as being AI companies that really aren't.
Absolutely. Yeah. I mean, we have pillars in our portfolio like an XAI, which I think we may have talked about before, but you look at what Elon's done just in the past 6 months, and the discussions around macro hard as a launch and a new disruptor for traditional software, X Money being an augmented new capability on X, such that you have a real credible super app, which you have not really had to date in the United States. You've seen them in Asia, you've seen them in Latin America, but a real super app in America, which Elon is building. We're super excited about that. As you then look at the software landscape, which right now we think is at a very pivotal point. If you look at hedge fund positioning in semiconductors, it's at the 99th percentile, very crowded, because again, it's a direct levered play towards AI consumption and AI compute. You then look at software, 5th percentile. So people are pivoting towards semis away from software because software could very much be disrupted by this new wave of AI. So where we're investing in software is leading companies that are built on AI, that are relatively new, that we think will withstand this period of disruption. So Deal, for example, in HR software and payroll, Ramp in Office of the CFO software and expense management. We think those are companies that are built along with Databricks and Plaid and others to withstand this period of disruption.
All right, Paul, great insights. Great to catch up with you. Paul Abrahimzadeh, over at 1789 Capital. When we come back, we're going to talk about our stock of the hour, and it's a closer look at Birkenstock. The share is down here on a warning for slowing sales growth. That's coming up next here on The Close. This is Bloomberg. All right, time now for our stock of the hour. Taking a closer look at shares of Birkenstock having their worst day since at least August of last year on weaker than expected sales growth forecasts. The sandal maker citing pressures from tariffs, a weaker U.S. dollar, amongst a few other things. Norah Mulinda joins us right now, Bloomberg's markets correspondent, to talk a little bit more about what is exactly ailing this company, because I felt like earlier this year, everybody was talking about how great they were doing, and it seemed like Birkenstocks were at least in the cultural zeitgeist. Are we just not wearing them anymore?
Okay, so demand is still there. That's what I'm seeing. Demand is still there, but investors are really hung up on the forecast moving forward. Yeah. They, of course, are talking about slow sales growth heading into 2026 for that year. And they're citing tariffs and also a weakening U.S. dollar. Of course, we know this is a German-based company, but about half of their revenue comes from U.S. sales. So when you think about the dynamic of U.S. currencies and all that we've been seeing in terms of a weakening U.S. dollar, they're seeing this as potentially hampering some of the metrics and the progress that they'll be able to see in 2026. So that's what the general concern is. If you look at shares, are down about 27% so far this year. So just broadly seeing this stock and a lot of the other retailers struggling.
Yeah, it's an interesting point, too, on the dollar, given that they report their earnings in euros. So certainly a lot of cross-currency impacts there. How does what we're seeing with Birkenstock, they're having a uniquely bad year, how does that compare to their peer set, though?
So this isn't necessarily uncommon for the peer set if we think about retailers more broadly in the reports that we've been receiving here. I mean, it's a changing consumer behavior that we've been seeing, economic headwinds, of course, tariffs. That's been the buzzword that we've been talking about all year, and something that still remains a stressor point for a lot of these companies that we've been seeing reporting in recent weeks. So it's not necessarily exclusive to Birkenstock. While they do have these issues, they were talking about their sandals and clogs and the tariff concerns that they're expecting in terms of those products in particular. But when we think about the broader retailer, it really has been a mixed picture that we've gotten from this earnings season. Of course, we're going to have Nike reporting after the closing bell today.
Yeah, and it's kind of funny, too. I mean, obviously, Nike, a slightly different story, different customer, not going to have the same currency headwinds that Birkenstock would have. But it gets also to this idea of how do you sort of stay in the zeitgeist. And there's always that consumer spending story. But at the end of the day, day, people are always going to be buying shoes. It's just a matter of what's relevant and I guess what people gravitate to.
And their peer is On Holdings, which I know that's really been a popular name, but they've also been struggling.
I don't know anyone who wears those.
You don't?
No.
I didn't know.
They were hot for a while.
They had a moment. They're down about 11% this year if you think about the comparison there. So that's their major peer when I was looking at it on the terminal here. But I mean, that really is a conversation is about where are people spending their money. And a lot of people have brand loyalty. When I think about my friends, some of them are obsessed with Birkenstocks, but they're the only people that I really hear going toward them when they're shopping for different names. So I think it depends on, do you like Nike? Do you like Adidas? Do you like Birkenstock?
I'm sorry, you were saying On is a competitor to Birkenstock or to Nike?
To Birkenstock.
Oh, really?
Yeah.
Oh, okay.
If you
They
run,
do have sneakers. You know.
Okay. Oh, yeah, I didn't think of that. Sorry.
No. Run PC on the terminal, PC Go, and it comes up as a competitor.
Great plug for the Bloomberg terminal.
What
Great
happened
machine.
to Dr. Scholl's? Remember those those wooden clogs?
Yeah.
Could you do those slip-ins, do the inserts for your shoes?
Yeah, you could get them at like a CVS. I remember that. Anyway.
Is that a selling point?
What a time.
Norah, great reporting as always. That is Bloomberg Markets correspondent Norah Mulinda. I will say, Romaine, I will be buried in a pair of Hoka's.
Hoka's,
Brand loyalty is certainly a very real factor when it comes to basically the footwear category.
Are you just on like a subscription plan for Hoka? Like just once a month they just send you a new pair?
Every 6 months I find myself buying a pair, but it's all manual.
No, manual. Okay, all right, we got to automate that.
Anyway, the closing bell is up next. We're going to take you there with Jose Rasco. He is Chief Investment Officer over at HSBC Americas. This is The Close on Bloomberg.
Two of the things that we have been paying attention to is what is driving equity markets has been very much around earnings growth, and what has been driving bond markets, and especially around the lower volatility that you just pointed to in the bond markets, has been around the Fed delivering what is expected from them and the Treasury delivering what is expected from them, and really with that taking a little bit of volatility out of the markets, and that's exactly what we have got.
Gargi Chaudhuri, head of iShares investment strategy of the Americas over at Blackrock, kicking us off to the close just about 50 minutes ago. Katie Greifeld, a bit of a flip from what we saw yesterday with that significant sell-off, clawing back a good chunk of those losses today.
Yeah, absolutely. The S&P 500 higher by about 1%. That snaps 4 straight days of losses for the big benchmark. We are off session highs, but still can't complain about a 1% rally. Even more so if you take a look at big tech, the Nasdaq 100 higher by about 1.7%. You can thank Micron for a lot of that. The 10-year yield, you are seeing a little bit of a rally. We did get those CPI figures earlier today, a Swiss cheese report, if you will, as we were discussing, but still showing progress on inflation nonetheless. And the VIX, now we're trading with a 16 handle.
Yeah, absolutely. I've seen that drop down just a little bit here. Some of those technical levels that we were testing yesterday, now putting some distance between it here on this Thursday afternoon. Joining us right now here in Studio 2 is Jose Rasco, Chief Investment Officer over at HSBC Americas. Jose, great to see you here.
Great to see you.
Let's start to talk a little bit about the potential for this rally to extend. And I know the price action over the last few weeks has been a little disjointed for a wide variety of reasons. Assuming that smooths out into January and beyond, is there a bull case for broad markets right now in the U.S.?
Yeah, we remain optimistic. Now, that said, short term, we think we're going to see a bit of a repricing in equities continue into the first quarter, especially in the tech sector. As tech is going global, the AI trade is going global. That's increasing demand. That means higher prices, which is good for margins and earnings, but it does mean longer delivery times and more competition for those chips and computers. So that has to be repriced, and we think that's going to ferret out in the next couple of weeks.
And I'm curious about the balance in that, too. I mean, we were talking about the earnings report that we got out of Micron. It was great. Obviously, a lot of pricing power. Obviously not great if you're Dell or HP or somebody who has to buy that stuff to put into your computers. Where is the money going right now with regards to the tech and AI trade? I mean, what are investors really looking for right now as the big bet?
Well, I think the thing that investors have to realize is, computers and chips are inputs into AI. That is not AI. AI is a product and service that is derived and created from those inputs, right? So there's a lot of demand for those inputs, but what's going to happen and what's going to be really productivity enhancing and help boost profitability is the products and services that are being created currently. Remember, the second level of AI is not LLM. It's not just putting something on a website and people buy it and do free research papers. This is going to be working both sides of the balance sheet. It's a consulting arrangement, essentially, with the AI company and your companies.
It's interesting, though, to track the AI trade in markets because it feels like we've been in this sort of AI enabling sort of space for a while when it comes to the chips, when it comes to the picks and shovels. And there's been moments where it sort of evolves beyond that, maybe gets to that second order, that second level. But it still seems like a lot of the action, a lot of the excitement is around these chip makers.
Absolutely. And I think the concern is until we get to the point where people understand what are the new products and services that are being created that help reduce costs and lift revenues, what are those and where do they exist and who makes them? Until we get to that, we have to deal with the fact that chip demand and PC demand is so hot that the logistics are going to create a little slower earnings growth in the short term. That's part of that repricing. Longer term, we are extremely bullish. If you look at data center construction in Asia, booming. Look at what's happening here. So, and I know where you're going. Are we getting to a point where we have too many? Is that where we're going?
Well, yeah. Are we overbuilding? Let's go.
It could be, right? But I think we're a long way from that, right? And I think you have a lot of evolution that's going to take, you have evolution in chips, computing power. We haven't talked about quantum computing and all the edge computing capabilities that are coming in terms of chipsets and computers. That's going to revolutionize the industry. That means more spending, not less. Yeah. So you build today with today's technology and you evolve and revolutionize over time.
We've heard from a lot of investors, institutional investors, and particularly investors in the private market. They say they're less interested in owning, say, the data center, for example, and all the guts that go into it. They're more interested in the land and leaseback arrangements, or they're more interested in the power that is going to be adjacent to these centers to supply. I am curious if that maybe offers potentially better upside value longer term, given some of the high price points we're already seeing to invest in the actual data centers themselves.
In terms of opportunities to grow your portfolio, absolutely. We went positive on utilities because we think it's not energy, right? Energy is a lot of energy and there's going to be a ton more nuclear, et cetera, coming in the next year. Trump administration really pushing that, which is great. But electricity prices, where there are hyperscalers, are going up. So that means utilities should actually do well and get pricing power in Q1. Industrials, materials. Everybody needs the same bag of cement and everybody needs to build these facilities. And you want to look at that land. Absolutely. Yep.
So when it comes to the stock market loves stories. Obviously, the stock market is in love with the AI story. Are there any other tradable narratives out there, not just tradable, investable, that you can really put real money behind?
Absolutely. If you look at financials, right, the Fed just eased. We think the Fed is probably mostly done, if not done completely. They themselves only have one ease in the next 2 years, right? One in each year. And so that's not much. The bulk of it has been done. And I think what we're going to see from here is interest rates matter on the margin. It's about the growth story. And where do we see the growth story? If you look at financials, right? With that yield curve, you were talking before about the long end of the curve. Yeah. Guess what? That's a positive slope for banks. That's good. Look at regionals, consolidation in regionals. We're looking for that. Yeah. I think you're going to see more M&A, more IPOs next year. Yeah. We like financials, in addition to AI, industrials, materials, and all that we just discussed.
On the financials, it's interesting too, because I was going through the earnings season, the third quarter effectively, and you know, obviously you had great outperformance by tech, although a lot of that was sort of shifted into the semiconductor space. But financials kept their own too. I think, you know, at least for the S&P financials, it was something like 20+% year-over-year growth, which kept pace with tech. Does that continue for when we start to see the fourth quarter numbers and the first quarter numbers?
We think so. We think financials, you're going to see consolidation in two areas, media and financials. I think you're going to see consolidation next year. And so we think that makes sense. And financials do well when the economy's doing well. They do very well after the Fed eases. When the Fed eases, pauses, and eases again, financials are one of the top 3 sectors in the next 12 months. So we think it makes sense. The lower rates help. And the positive slope to the yield curve helps as well. And remember, we still think the economy avoids recession next year, right? So,
all right. Well, great insights here, and we'll see how things shake out. Jose, great to have you. Jose Rasco is Chief Investment Officer over at HSBC Americas, counting us down to the closing bells with just about 2.5 minutes to go. Katie, stocks firmly holding on in the green.
Absolutely. Not something we've seen for a while. As I mentioned at the top of this segment, we had a 4-day losing streak on the S&P 500, but that good news report from Micron really changed sentiment around.
Yeah, a real surprise, because everyone was saying they were going to be conservative on the guidance, nothing conservative about it at all. A full breakdown of those earnings, a full breakdown of Nike coming up after the bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us from the radio room. Welcome to our audiences across all of our Bloomberg platforms. That includes our partnership with YouTube. 24 hours ago, Carol, we started off this simulcast talking about the big sell-off in markets. Today, we start off talking about a pretty sizable rally.
Yeah, and thank you, Micron, really leading the way, just soaring in today's session and really raising the overall semiconductor area. That the SOX, the Philly SOX semiconductor index, it's up about 2.6%. It was up as much as 4% earlier in the session, but still a big gain, and that is certainly providing some momentum.
Carol's horrified right now because I just shared with her that the PATH train, and Katie, this is in your world too.
Yeah, please go on.
The PATH train, it's going to rise to $4 per trip by 2029.
That actually is news to me, and that is horrifying.
Carol was freaked out.
I was gobsmacked. God. Like, that's $8 one day
just
round
to
trip.
go to work. Man.
Romaine,
that's not even the subway.
Romaine, this doesn't concern you.
Yeah, I don't know what you're talking about.
Romaine doesn't leave the Isle of Manhattan.
Anywhere? Is that like,
yes.
There's a limo every day.
Is that like that mythical S train that runs to Brooklyn or something?
No, it's a real train. It's great. It's clean. It runs on a schedule. But
well, there you go. And there's your $4. That sounds like some value.
Just swim across the river. I don't care.
You and me both. I'll swim with you.
I'm sorry to be the bearer of bad news, Katie.
Thanks, Tim.
Yeah.
All right, well, here on this Thursday afternoon, for those folks who don't have to catch the PATH train, stick around. We are going to get some earnings in just a few moments out of FedEx and Nike, one of the last big companies to report this earnings season. Green across the screen, some optimism coming out of the latest economic data, some optimism coming out of the Micron numbers last night. The Dow Jones Industrial Average higher by about 69 points, or 1/10%. The S&P up more than 50 points, or 0.8%. The NASDAQ, that's your outperformer. The composite up 1.4%. The NASDAQ 100 up 1.5. The Russell 2000 says it wants to participate as well, adding about 16 points, or 0.6%.
All right, back to the S&P 500 I go, and you've got kind of an even split again. Another day, S&P 500, 263 names to the upside, guys, 237 to the downside. Katie, 3 unchanged.
Let's take a look at the circle, because it's also pretty much an even split, but visually represented, you can see there is a lot more green than red. A lot of that has to do with the fact that tech, communication services, really outperforming today. That is a bright, beautiful green. But then you take a look at what didn't do too hot, and it was energy. This actually was your outperformer yesterday, but that was your biggest loser on a percent basis. Also, consumer staples losing quite a bit today, down about 0.7%. But that just speaks to the risk-on action, Carol.
All right, there's a lot of green there. I had a fair amount of things to choose from, but let's go right to Micron Technology, guys. At its highs, up 17% today, finishing with a gain of just over 10%. A top gainer in the S&P 500 and NASDAQ 100. As we know, we broke it down last night. The company gave an upbeat forecast for the current quarter, signaling surging demand and supply shortages are allowing the company to charge more for products. We saw that on top line in terms of growth. We certainly saw that in margins. So appetite, the voracious appetite for AI computing components, definitely pushing Micron to the upside. And then we just threw in the SOX there, because that too, some outperformance there, up 2.5% in today's session. Speaking of a gainer, Lulu, let's go over there. That was a top gainer in the NASDAQ 100, and that one at its highs up 8.7% today, finishing with a gain of about 3.5%. This as it came out that activist investor Elliott Investment Management has built a stake of more than $1 billion in Lululemon. They've been working with the retail executive Jane Nielsen, who is viewed as a potential CEO candidate to take over for the CEO Calvin McDonald, who we know is on his way out. But we know this is a company that has dealt with slowing growth and some other issues, a lot of competition in this space. Its stock is down nearly 50% so far this year, and about 7% of the float is short. And then I want to go to Trump Media and Technology. Check this one out, up almost 42% in today's session. This is kind of added to my list a little bit later on. This as the company came out and said it is getting into nuclear fusion. Who'da thunk? The company said it will merge with TAE Technologies. It's a closely held fusion developer founded back in 1998. It's a transaction valued at more than $6 billion. So, of course, Trump Media behind Truth Social. They're in a bunch of other things, but again, kind of pivoting the business, expanding out into fusion. We talked with our Will Wade and says, fusion, it's a while away. Yeah.
All right, those are the gainers, some big gainers there. I got a few decliners, including a pretty big one. HPQ, HP Inc., down 4% today. Hardware stocks took a bit of a hit today, some of them. Bloomberg Intelligence on Wednesday did flag concerns about HPQ's earnings, saying that fiscal 2026 EPS estimates have reset lower, reflecting expectations of PC margin compression from DRAM inflation and tight supply, hence Micron's good day. And these dynamics represent a 30-cent hit to EPS. That's according to the company. Woo Jin Ho wrote that of Bloomberg Intelligence. HP shares falling, HP Inc. falling 4% today. Bergenstock also taking a hit, down 11.3%. Its worst day in more than a year. This after the company predicted a slower pace of sales growth in the coming year due to the impact of a weaker U.S. dollar and tariffs as well. Bergenstock expects sales to probably rise by as much as 15% in fiscal 2026 in constant currency terms. That implies annual revenue of as much as 2.35 billion euros. It's slightly below analyst expectations. And finally, Inspire Medical Systems. We talked to the CEO, Tim Herbert, quite frequently on our program. They make a medical device to treat sleep apnea, down 19.5% today. This after two regional Medicare contractors removed the new higher paying code that would affect Inspire's product to treat obstructive sleep apnea. JP Morgan calls the removal, quote, a disappointing reversal that represents a significant reduction in reimbursement relative to expectations for next year.
All right, well, speaking of reversals, let's take a look at yields. We did see a big drop in yields around 8:30 a.m. this morning when we got that CPI data as well as the jobless claims numbers. Those competed against each other, and you did see some of the worst of that drop in yields peel back just a bit. The net result of it all there on your screen, only down about 2 basis points on your 2-year yield after being down as much as 6 to 7 basis points. Your 10-year yield going to close out the day down by about 4 basis points.
Yeah, really interesting to see that bid come into the bond market. On the heels of that CPI print, there were a lot of nuances there. We know that it was muddied, if you will, by the government shutdown. I love the headline on the Bloomberg terminal calling it basically a Swiss cheese report. But you take a look at the market reaction. I mean, they're taking those numbers and they're saying that, you know, perhaps the Fed is going to hike a little bit more than maybe we expected in 2026.
Yeah, and kind of interesting. It was just yesterday, right, Romaine? I think you highlighted that, you know, the S&P 500 dipping below that 50-day moving average. Well, our Bill Maloney was just on with us too, and it just went back up above the 50-day moving average. So trying to figure out this trend line is something we'll have to watch into the new year.
Well, I was watching this too because, I mean, if you remember, I mean, what was it? The kind of in mid-November, we also had a retest of some of those key moving averages, and you ended up getting a nice bounce off of it. I think the S&P ended up rallying like 6 to 7% after hitting that line back in mid-November. But it does get to this idea that a lot of what we've seen in this equity market has not been a true sell-off. It's been much more of a rotation, just a rotation out of those some higher weighted names, which of course then drags everything down. But that money has for the most part stayed within the market.
Well, we're starting to get some targets for the S&P 500 for next year. We spoke to Ryan Dietrich of the Carson Group. He was on our show just a few minutes ago. And he's been right for the past 3 years. He's very bullish when it comes to his outlook. But he says after a year, and he's a technicals guy, so after a year like we saw with the so-called Liberation Day and the lows of April and the rise since then, we're poised to see an increase on the S&P next year of 10 to 15%.
Hey guys, I know we're waiting earnings out of FedEx and Nike, but I want to there was an interesting story in the Bloomberg terminal. You guys are on the radio, but for reasons that never were explained to me, also on TV. But this has been like a trend now, and you've seen this actually play out with podcasting. And YouTube has actually really kind of gone all in on this. The idea that what used to be confined to just, you know, your ears has now become video as the main medium. And of course, they have ridden that wave to boost viewership and subscribership as well, though I do think we are getting earnings now out of FedEx. As
much as I would love to go into that a little bit more, FedEx, here is the red headline on the Bloomberg terminal. It sees full year adjusted EPS $17.80 to $19. Previously, it had seen $17.20 to $19, so bringing up the lower end of that range there. It sees full year capex $4.5 billion. That is in line with its previous guidance and estimates as well. Adjusted operating income for the second quarter they see at $1.61 billion. The estimate had been for $1.36 billion. Really interesting to see that guidance raise here, Tim.
All right, what's the stock doing? Up 3.3% in the after hours, up about 3% 1% in the after hours. Raj Subramanian, FedEx's president and CEO, said the company delivered an outstanding second quarter, successfully executed our growth strategy, and advanced our network transformation while navigating a highly challenging external environment. He continues to say he's proud of the team members worldwide for their commitment to FedEx.
I think it's interesting, too, when you think about the turnaround plan that he took over. Obviously, a lot of it was also about moving into higher value business, meaning higher value deliveries, but also cutting costs. They do talk about that they are sticking by those cost reductions and saying that those cost reductions so far will be permanent in their words, and that savings from that will then, of course, be reinvested back into other parts of the business.
Yeah, they talk about FedEx Freight segment operating results decreased during the quarter due to lower shipments, higher wage rates, and the hiring of additional dedicated LTL sales professionals in preparation. It does sound like they still have some challenges, but we did see the stock pop a little bit higher in the aftermarket. All right, folks, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, YouTube and TV, all of us.
Oh,
just saying.
The future is now.
You've heard of TV on the radio, right?
I might need to get another job, though, to pay for my path.
Yeah, that's true.
Katie, what are we going to do?
It's awful.
All right, guys.
Carpool.
We could. Hey,
Could
Katie.
move into civilization.
That's
in
all
the
right.
city.
All right, that hurts, Hey, Katie and Romaine continuing there on the close on TV. Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. We'll see.
Those earnings from FedEx just crossing the wire. We're going to take a deeper dive into those when we come back after the break. And we're also awaiting earnings out of Nike, two distinct companies, but both with an interesting read on consumer spending. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A bit of a rebound from the sell-off that we had yesterday with the S&P 500 pushing higher on the day by about 0.8% here. You did see the NASDAQ indices get in on the action, up about 1.5% for the NASDAQ 100, 2.5% for the Philadelphia Semiconductor Index. Those earnings about 24 hours ago out of Micron, and more importantly, the forecast that they gave, providing a lot more confidence that the AI trade can continue going. As for the economy and the direction of yields, a bit more of a mixed bag. We did see yields across the curve dip slightly here on the day, down about 2 to 3 basis points on the 2-year. And Bitcoin continues to be under pressure now, right around that $85,000 level.
All right, let's take a look at some of the day's biggest movers. We have to shout out Micron, of course, reporting earnings just about 24 hours to go. That was worth a 10% pop in the stock. Tesla continuing its winning ways. It did touch a fresh record high today, but it's going to finish a little bit lower than that. And Tilray, this is a really interesting one. You did have President Trump reschedule marijuana, but we had such a big run up in marijuana stocks that Tilray falling a little bit on the news. But that was what was. Let's talk about our top story this hour, and that is two key bellwethers reporting earnings, offering fresh insight into the consumer and the economy. Nike results due any moment now, with a focus on the company's next turnaround steps and the running category in the spotlight. Meanwhile, FedEx just reporting results, and the takeaway there, Romaine, is that they boosted their profit forecast with that sweeping overall that they've been orchestrating, gaining some traction.
All right, $1 billion in permanent cost reductions for 2026, which, of course, has to do, taking that ground business and air cargo business here and merging them together. Peter McNally joins us right now, global head of sector analysts over at Third Bridge. Peter, what'd you make of the results?
Well, it looks like FedEx is still a big story about self-help. I mean, the revenue number was about 3% better than forecast, not that much. And, you know, the consensus estimates have been a little bit skeptical on FedEx's top line growth. However, you know, the big story was a 71-cent beat on earnings per share. So it looks like, you know, cost control continues to be the story here. They haven't had any macro tailwinds in a long time. And when that comes, you know, the play here is for, you know, operating leverage, but we might just see the first stages of that now.
And Peter, you write in your preview that investing in FedEx has required a lot of patience in recent years. You take a look at the share performance, and certainly a lot of folks would agree with you. But you think about where the company stands right now, especially with this turnaround, this overhaul that they've been putting through. How much more patience is needed at this point before we finally start to see some of those flowers in the shares themselves?
Well, calendar 2026 is setting up to be, pretty interesting for FedEx. I mean, we have the spin of the freight business, which is a, really high multiple business in the market. And while like overall in the macro case, there's a little bit of excess capacity, this is a good business, and FedEx is a major player, in that. At the same time, they're going to, continue with these cost cuts. And as I said earlier, they haven't had any top line help in a long time. Our experts telling us they continue to gain share versus UPS, but all these headwinds in 2025 around trade, tariffs, slower economy, could eventually start to turn around and then drive some real growth. And then, for a company that's had 3 years of stagnant earnings, you could really be looking at a takeoff in 2026.
All right, Peter, always great to catch up with you. Peter McNally, Global Head of Sector Analyst over at Third Bridge. A turnaround story for FedEx. It appears to be gaining traction. Meanwhile, another turnaround story we've been keeping an eye on is with Nike. Those earnings now crossing the wire here. The numbers for the company's fiscal second quarter largely in line with estimates. Revenue coming in at about $12.43 billion, up just a little less than 1% year over year. The street was looking for about $12.24 billion on average. Direct revenue did continue to decline, down 8% year over year, and came in slightly below expectations at $4.6 billion. But wholesale revenue appeared to come in a bit above estimates at about $7.5 billion, a growth rate of about 8.7%. Digital sales, Katie, in the quarter down about 14% year over year, but that's actually an improvement over what we had seen a year ago. Margins in line with estimates at 40.6%.
And you can see that traders deciding what to do with the shares after hours has been bouncing back and forth. Here to break down these results with a little bit more detail is Poonam Goyal of Bloomberg Intelligence. She covers retail there. So Poonam, you've had about 60 seconds to go through these numbers. What sticks out to you?
I think the numbers were actually very good. If I look at the piece of the business that's working best, it's the wholesale business, and that's where the newness is. The results were fantastic, up 8% versus a low single-digit expectation. Very, very good. Inventories down 3%. Once again, they're clearing out what they need to clear out, and we see that in the decline that we saw in direct, right? That channel remains pressured. I'd say overall, these numbers look pretty good. They show that Nike is making progress. The strength in wholesale was particularly encouraging in addition to North America. I'd say the weakness is still China and also in the DTC channel, which we kind of expected.
I am curious about the weakness in the DTC channel. Is that an inventory issue or what's going on there? Give me some color.
Yeah, so if you think about all the excess inventory that Nike has had over the years that it's been trying to work down, it's all being cleared through the direct channel, which is why you see weakness there. Part of that is just the lower price points that are going through that channel to clear out that inventory. And the newness is really residing in the wholesale channels and on Nike's flagship stores mostly.
And it's interesting that we see the headline on the terminal crossing now that it's really this quarterly revenue jump that seems to be a bit of the surprise here. It's not necessarily making its way into shares of Nike after hour. And I just wonder, Poonam, where sentiment stands on this stock, because we've been talking about this turnaround for quite a while now, but you take a look at shares, it just feels like they can't quite get their legs back under them. What do we need to hear on the call to actually, shift the sentiment wave?
I think there's two things that I'm looking to hear. One is on the DTC channel, are we close to the bottom? Have they cleared out the inventory that they want to clear out, or how far are we from that? And the second thing I want to hear on is China. What do they need to do to improve in China? Because China results were much weaker than expected, and that is a clear growth region for them in the years ahead.
I am curious on the inventory side, though. I mean, I'm just kind of going through. And the inventories aren't bad. I mean, they're still elevated. They've come down a little bit. But as a percentage of their total business, is it any worse than maybe what it has been historically?
Inventory is still elevated, and you see that in the direct channels results that were down 8%. They still have a lot of aged inventory that they need to get rid of, or say old styles, right? They need to bring more newness into their channels, their own channels. And to do that, they've got to get rid of those old inventory products that no one really wants to buy anymore.
All right, Poonam, always appreciate the instant analysis. Poonam Goyal over at Bloomberg Intelligence, a deeper dive into Nike. The shares down about 1% as you wait for that conference call to start at the top of the hour, but relatively in line on most of the main estimates here in inventory now, trying to get that under control, particularly under the relatively new CEO. We want to stick with Nike and talk a little bit more about some of the momentum, if at all, for them and really the broader apparel and retail space. Deborah Weinswig joins us right now, the founder and CEO at CoreSight Research. Deborah, let's start off first with Nike, which I would think kind of falls more into the premium category, at least the perception of premium category when it comes to apparel, certainly casual apparel here. Does that work in their favor or does that work against them in the current economic environment?
First, thanks for having me on. Secondly, I think it works for them because you have the consumer who's looking to make investments where it makes sense, but also they're looking for the deal. So it's kind of this barbell, but I think you hit the nail on the head in terms of how they're positioned.
What are you getting a sense in terms of how the consumer views Nike? I know there are a lot of scores that people kind of use to kind of see just how much traction a brand has. And I know Nike sort of went down that list, at least in the years prior to this year. Have they gotten some of that mojo back, that awareness and that that's just that standing, that stature?
All of the data would suggest exactly that. We do a lot of survey work and we speak to a lot of consumers, and 2 in 5 would recommend Nike to a friend, and that's up from 1 in 5 a year ago at the same time. And so, it's really interesting if you juxtapose this to, Lululemon, where they are seeing amazing strength in China. They've had some of the same kind of missteps in the U.S. with regards to assortment. They don't have the same inventory challenge. But if you think about, kind of what Poonam said, like keeping your eye on the prize, right, it's really China.
Yeah, it's interesting. And, you mentioned Lulu. I mean, compare and contrast here because, okay, Lulu is apparently managing the China situation a little bit better, but it's not like it's been a rose garden for Lululemon investors either, especially when you think about, now this activist stake coming from Elliott.
Yeah, I think what's really interesting is I've always looked at C-suite changes as an indication of where things are going. And right, Lulu just made a big change at the top, like CTO, COO, et cetera. And Nike cannot hang on to their innovation talent. I mean, it is like a revolving door like I've never seen, to be quite honest, in any company in my entire career. And so I do worry, honestly, from kind of like my essence, that there is something still off at Nike, and we've seen one change at Lulu to address, I think, some of the challenges they were facing. Right, that's been done. I think they're kind of cleaning house, if you will. But I feel with Nike, it's kind of like 2 steps forward and 5 steps back. And so I think that it goes back to there's a huge amount of opportunity for the shares. But I still think that there's something a little bit off. And like we were saying, right, they have a lot of inventory that nobody wants.
Yeah. Yeah, I feel like Nike is being hit from multiple angles here. And at least 2 of them are, of course, the trade landscape, the tariff conversation. And then there's the maybe more existential question of how do you become cool again? We've been talking about that for years when it comes to Nike. And that feels more ephemeral, Deborah. And I don't necessarily know how you solve that puzzle.
Well, and one other thing to think about on the China landscape, right, is Lulu doesn't have the same kind of direct competition that Nike does with like Li Ning and Anta. And so I think also you have to think about how to be, and right now, right, these technological advances, yes, there's a lot. I've actually been studying this a lot in the footwear space specifically. There is a lot that Nike's doing, but their ability to communicate that and to point out, right, where they are from a technological perspective different than the landscape. Yeah. They're having trouble communicating. And I think, and then you kind of put that on top of all of this turnover in their innovation team. There's something more there.
Deborah, I had a chance a couple months ago actually catch up with the CEO as well as some of his deputies, including the head of the Nike brand and their chief design product officer, Phil McCartney. I want you to listen to something he had to say to me about the difference that they're taking with regards to how they're marketing their products going forward.
Our business is driven by a portfolio. We're going to obsess sports. I think that's been, since Elliott returned, that's been a key part of our charge as a leadership team. and we're already starting to see the fruits. You know, the running team were the first team to go into this new offense, and we're seeing the results of obsessing an athlete, obsessing the innovation for athlete, obsessing the marketplace, obsessing the community.
And this was like the persistent messaging, Deborah, the idea of a refocus on the athletes and a little bit of a nod to the previous CEO who maybe focused a little bit too much on fashion and leisure rather than the athletic side of the business. Does athletics get them back to where they were?
Yeah, I think going back to my prior point around like the technical side of it, I do think that they are doing all of the right things. So I would agree with what Phil said exactly, but I don't know if they're doing a great job of communicating that. So it's like, it's maybe a better problem to have. You've got the right product, but to communicate that to the right people, that's their challenge right now. I mean, I actually think it's more of a marketing problem than a product problem, right? They've got product right now that they've got to clear. But I think on the horizon, things should be better if they can, I think, keep their innovation team stable and, right, get their marketing message straight.
Absolutely. Well, Deborah, we're having this conversation on December 18th. The Christmas shopping holidays right around the corner. I have to imagine that a lot of people, that doesn't include myself, have their holiday shopping done with at this point. What are you seeing when it comes to the health of the consumer, the strength of that shopper in this very critical time for the season overall?
I was worried you were going to ask me that. So it's interesting, right? We have a whole research team, right? These are all fundamental analysts, PhDs, et cetera, some, kind of Wall Street backgrounds, et cetera. And they were more concerned about the holiday season than I'd say most. And, there was, and it was just data driven, right? So you got the quant and you layer the qual on top of it. And what was interesting is, right, the qualitative conversation was so positive, right? It came out after Black Friday and whatnot, but it's kind of like that, that little kind of, sitting on my shoulder. And I will say, it's interesting. We had people out in stores today across the U.S. I'll send you the photos afterwards, because going back to, I've never quite seen anything like it. There are literally on handwritten notes, right? 30% off. So these are unplanned, right? Unplanned promotions, which you don't usually see right now. And so I do wonder if there's, some of these higher prices maybe had a bigger impact than what people expected. The discounts weren't as deep as everyone had thought, but I will say it's a little bit less rosy than I think we had hoped.
All right, Deborah, up against the clock. It's always great to speak with you. Really appreciate your time. That is Deborah Winswig. She is founder and CEO over at CoreSight Research. Now coming up, FedEx reporting results just a few minutes earlier. We're going to bring you more details coming up next. This is The Close on Bloomberg. FedEx reporting results a little while earlier, with the parcel carrier higher by about 2.5% in after-hours trading. Now, the earnings dropping at a time of heightened competition, with Uber and DoorDash taking aim at retail delivery. Our next guest says that this poses a conundrum for UPS and FedEx of whether they should retreat from low-margin residential e-commerce delivery or meet it head-on. Joining us now is Bloomberg opinion columnist Thomas Black. So I'll ask you that same question. I mean, has your answer changed in the 30 minutes or so since we've gotten these results?
I think it's been backed up a bit. We saw FedEx, especially on the parcel side, increase revenue, and a lot of that was on what they call yield or higher prices. So it's clear that they're going after price and not so much volume.
So after price, and is this gets to the idea of, I guess, a stronger B2B business, but the idea of just higher value items? And if so, Tom, where was that business before? Because I always thought that's what they always trafficked in.
Yeah, they're moving into things like healthcare, where you have a lot of cold chain movements, which are higher priced. They also want to do more business packages and large, oversized packages, which is something that they specialize in, and it's something that UPS has kind of backed away from. So it's helped FedEx in that sense.
Yeah, FedEx versus UPS is a really interesting chart because, we know that FedEx investors, as a previous guest phrased it, have had to be patient over the past couple of years. But you take a look at how they're performing in 2025, actually slightly higher year to date. I can't say the same for UPS, underwater by about 28% or rather, sorry, that's an old figure, down by 13% year to date. So real divergence is forming between these two. And I wonder, whether you think that UPS is able to gain a little bit more traction here.
The difficulty is that UPS has a lot of its costs locked in, and that's especially around the union wages, which are the highest in the industry. So it doesn't have as much flexibility as FedEx does to cut cost. And FedEx has undergone a very transformative period for itself. Since Raj Subramaniam became CEO, they've cut costs, but they've taken out about $4 billion of annual costs, and they're still going. So the network hasn't shown its potential yet because the market is so weak. But a lot of analysts think that once you start to get the demand to come back online, margins will pop.
All right, Tom. Always appreciate it. Thomas Black, Bloomberg Opinion columnist, a deeper dive into the results that we got out of FedEx, of course, seen as a bit of an economic bellwether, along with those results we got out of Nike, rounding out what has been a relatively full and robust earnings season. And we just want to update you real quick here on the holiday schedule. A little bit earlier today, we learned the President of the United States was going to close down the federal government on the day before Christmas and the day after Christmas. Of course, Christmas Day has always been a national holiday. We're now learning from the NYSE that they plan to remain open with their normal hours that they had already had scheduled. So for December 24th, Christmas Eve, they will be open to 1 p.m., that shortened day, and they will have the full day on the 26th, the day after Christmas. All right, when we come back, we're going to talk a little bit more about the investing landscape and the retail investor. Charles Schwab riding that investing wave, rolling out updates to its platform to enhance that experience. A conversation up ahead with James Kostulias, head of trading services at Charles Schwab. This is Bloomberg. All right, well, Charles Schwab has been enhancing its retail trading operation with platform updates and new consulting roles at its physical locations. A roaring year for retail investing, with one recent analysis showing payment for order flow at top brokers growing more than 50% in the third quarter. Joining us now to talk a little bit more about this trend is James Kostulias, head of trading services over at Charles Schwab. James, great to have you here.
Thanks, Romaine. It's great to be here.
Let's talk about that wave. And I guess more importantly, is it temporary? Is there some temporary blip that led to this, or is this more of a structural change in what we're seeing?
Yeah, I think from what we've seen since the vol shocks in April, it's been really consistent. And we've seen phenomenal levels of retail engagement. And so we're 3 consecutive quarters now with 7 million plus daily average trades, which is a really high number at a time when volatility index hasn't been all that high, right? But I think what we've seen are spikes in volatility, like day shocks or a couple of day shocks. And so it's keeping the retail investor and trader highly, highly engaged. And I don't see anything on the horizon that's really going to stop it right now.
How do you, meaning Schwab, keep them engaged relative to some of the upstarts that have come in and obviously tried to steal some of the thunder? I mean, you think about the evolution of Schwab from basically the early days of mutual funds and all that to now what has basically been a much different market. Are you keeping up?
Yeah. So you talked a little bit about the platform enhancement. So enhancing the platform is one way, constantly listening to our clients. We did about 8.4 million trades a day in November. So I think we're more than keeping up. I think it's still a combination of your platform, your service. We've got 1,200 trade professionals on the trade desk, available 24/7 to support our clients, education, which has been huge, especially in times of uncertainty around these markets, really robust risk management tools, and then the product side as well. We see a lot of engagement with options, especially since April. Those volumes have continued to rise.
Well, I want to talk a little bit about the point you were making on trading volume, that the VIX has been relatively contained, and it's interesting to still see this trading volume. I'm actually watching a mirror trend, or the same trend when it comes in ETFs. You had trading volume hit an all-time high, even though you normally only see that when it's a rocky sort of market. So I wonder what that says to you, because typically you think volatility leads to greater trading volume, but maybe these figures suggest there is something more structural going on.
Yeah, it's a fabulous point, Katie, and I couldn't agree more. Historically, the correlation between the VIX and trading volumes was like a perfect beta, literally a perfect beta. And I think what we're really seeing this year is, it's not the volatility anymore, but the threat of volatility. For a while in April, it was a potential tweet that was coming out. It was potential news about tariffs. Now it's more around the AI trade, right? Like take yesterday as a great example. You had some numbers put up by Oracle that sort of soured on the AI trade, and you had a big low day. And now today you've had a nice update. We gave some of it back later in the day, but sort of the Micron news sort of sparked that. And so even though over the course of the last 6 weeks, the S&P has been very range bound, 66 to 69 at a high, but really 66 to 68 sort of range. But you see pockets of volatility over shortened periods of time, which I think is keeping people really engaged, not just in the market day, but in the 24/7 window, 24/5 window as well.
Let's talk about that 24/5 window, because there's been a lot of talk about extending trading hours. And the question I always have is, do people really want to trade at like 3 a.m.? Who's out there actually in their pajamas trading? What sort of uptake are you actually seeing?
Yeah, when is too much, right? That's a great question, Katie. I think the answer is people want to trade in those windows when there's a reason to trade in those windows. So it's not, I do my routine, I brush my teeth, I get my PJs, and I trade Microsoft or NVIDIA or any of the big tech companies. But when there's earnings, when there's a big news event, when there's potentially political unrest in the Middle East, you'll see in the oil companies and stuff. That's when we see our retail traders get highly engaged. But on a normal day, I mean, we're averaging 80 to 100,000 trades a night in that window. So it's not no volume, but it's certainly a pittance when compared to the broader day. But we think of it as an important tool in the toolbox for when you need it.
This year, obviously, given I guess political risk obviously drove a lot of market volatility. There are some people looking to next year and saying it could be even worse given a midterm election here in the United States, as well as some other things going on internationally that have to be resolved. Do you anticipate those? Do you guys look at that kind of these kind of I guess more nebulous things on the horizon and say, okay, we need to make sure our platform is ready for this if something does happen?
We're constantly looking at all the exogenous factors, Romain, and I would say we're scaled well beyond the numbers that I quoted you, like 3x the numbers that I quoted you. So are your platforms ready? They're always ready for that. We do look, though, sort of out there to try to guess and sort of feel for what's going on, more to help our clients and more to help our clients and educate our clients. And some of that we'll use for staffing levels to make sure we've got maximum support on the service desk. And so I tend to agree with you. I think the only thing certain right now is we're going to have a lot more uncertainty. So buckle up.
Yeah, an evergreen phrase there. I want to talk about what people are actually trading. We're talking about equities, but let's talk a little bit about ETFs. That's the sandbox in which I like to play.
Sure.
What kind of activity are you seeing there? People, going for single stocks versus maybe baskets of stocks?
Yeah, so we always see a robust ETF volume, Katie, especially in the metals and especially in crypto. And so we custody almost 25% of the crypto ETFs at Schwab, meaning our clients hold those positions. And so crypto ETFs are always popular. Our clients have been more bearish on those, quite frankly. Not necessarily selling those positions, but certainly hedging those positions. To the contrary, we've seen a lot of bullishness in the metals. Across multiple demographics, which is one thing that was a little surprising to me. You've got sort of Gen Z as big buyers of gold and silver right now, which sort of historically would have said, the same ones who are hedging their crypto positions right now a little bit more than normal.
Absolutely.
My people. I love gold bugs.
There you go. James, it's always great to see you. Really appreciate you taking the time. That is James Kostulias. He is head of trading services over at Charles Schwab. Meanwhile, let's take a look at some of the notable movers in the after-hours trade. Actually, a busy slate of earnings. Nike down 5%, Romain. Those losses deepening.
Yeah, and I mean, the numbers were relatively in line with estimates. I think some of the concern here is that, we weren't talking about a material beat. The conference call is going to start in about, 15 minutes or so. So maybe they'll give a little bit more color on guidance.
Yeah, absolutely. It's going to be interesting to see what the C-suite has to say over at Nike HQ. Let's talk a little bit about FedEx as well. You can see shares rising a little bit here. Some evidence that their turnaround is bearing fruit. We know that they raised the lower end of their guidance, and certainly you're seeing that welcomed in the market after hours. KB Home, meanwhile, different story, down 5%.
Well, this is what I'm curious about, because, I mean, they did beat on revenue, they did beat on deliveries, but deliveries were down year over year by about 9%. But I think the real kicker here is the miss on earnings. The idea that they're selling, they're doing okay on the sales side, but clearly there's some pricing pressures there. EPS coming in at $1.55. The street was looking for $1.79, and that seems to suggest, I think a lot of the anecdotes we've had out there is that these home builders are still having to offer some incentives to get those homes off the market.
Yeah, absolutely. KB Homes was down about 3% heading into these results, and you can see that the year is getting a little bit worse. Meanwhile, moving on, AAA projects a record $8 million travelers will take domestic flights this holiday season as the seasonal travel rush continues. Our next guest looking to capitalize on that travel growth. Sentient has been transforming private air travel since 1999. I'm pleased to say that their president, Alan Walsh, joins us now. Alan, great to have you with us. We know that around the holidays, you see commercial air travel pick up in a big way. Does it then follow that you see a similar trend when it comes to the private jet landscape as well?
It does. Katie, great to meet you. Thanks for having me on to both yourself and Romain. It absolutely does. You know, from Sentient side, you mentioned, yes, we've been in operation for 25 years. We have 6,800 card owners, and yes, they like to travel. It's no different from the commercial world. You know, business, it is a peak season. December is that peak travel between the Christmas and the New Year timeframe. This season will be no different.
And talk to us a little bit about how your business works here. I know that you introduced, of course, a new industry segment with this idea of a jet card. Walk us through how that actually works.
So, you know, it is something that we invented, as mentioned, back in 1999. And really, you know, the cost of private aviation can be expensive when in your jet ownership or if you're in the fractional world. However, the jet card gives you the flexibility where it's asset light, where you can basically pre-purchase hours that then you can use at your discretion. We sell those in 25, 50 hour increments. But the hours don't expire and the rates are guaranteed and they're available anytime that you want. That's the beauty, you know, is the fact that you have them. They don't expire. So, you know, it gives people a lot of flexibility on a year-over-year basis.
I am curious, Alan, just about kind of the behavior of your passengers. Are they booking last minute for trips, or are they the kind of people that are these are the types of trips that they're taking that could be done months in advance? What does it look like?
It's a bit of both, Romain, to be perfectly honest. Thanks for asking. We do see, you know, more and more, I think, coming out of COVID, we saw an explosion in travel. I mean, that has somewhat abated. But I think what it has done is given people a different mindset when it comes to travel now, where it's become more on the experiential side as a business, you know, and not just a business necessity as to what some of the things were before. But on the experiential side, people do pre-plan. And when you look at something like December now, yes, you know, people take the same trips to the same places to be with family every year, and they will pre-book months out. But at the same time, you're always going to have the last minute travel, of course. But typically you're going to see for seasonal travel like this, it's many, many weeks out.
What type of destinations are you seeing people go to? Anything that's kind of relatively new, maybe, that we've seen this year relative to past?
Yeah, so the traditional routes are really northeast to southeast. You know, not shocking when you come from the cold northeast and you want to go to the warmer southeast during seasonal travel, and also escape into the mountains, into the Rockies, into Colorado for ski season. One of the trends that we are seeing, though, Romain, is people flying bigger and longer. So, you know, what does that mean? It really means the experiential travel aspect of it, where people want to travel with friends and family more. And that really comes into the end-to-end experience of a holiday and really, really spending time. That's probably the big trend that we're seeing.
That's really interesting because my perception has always been that, you know, people fly privately, basically domestically within the country, that when it comes to those international trips, that's something that you might actually book a commercial flight for. But listening to you, Alan, it kind of sounds like that trend is shifting a bit here.
It really is, yeah. I mean, if you look at places like the islands and the Caribbean, more and more they're becoming more popular. And the reason for that, Katie, is access. You know, you mentioned about the commercial and some of the challenges with the volume that we will see over the holiday period. But, you know, when you are flying private, you do have the flexibility to fly into smaller locations, shorter runways, greater flexibility. And it's become very, very attractive and accessible to people. So, again, it's a pickup. You know, we'll certainly see that type of travel really, really exponentially grow over the next couple of weeks.
Alan, really appreciate it. Some great insights here into a part of the business that we talk a lot about here on the show. Alan Walsh, Sentient president. A closer look here at private travel amongst those high net worth individuals. Meanwhile, we do want to kind of stick in the world of aerospace and specifically space itself. SpaceX astronaut Well, Jared Isaacman, we should say, he's a fintech billionaire. He started Shift4 Payments years ago. He's been a big backer of Elon Musk and SpaceX. He had been nominated earlier this year to run NASA. That nomination got scuttled, but the second time's a charm. He has now been confirmed to lead the space agency. It ends a prolonged nomination process, a process, of course, that raised a lot of questions about budget cuts and just the general direction of what the space agency is supposed to be. Now, fresh off the heels of that conversation, pleased to say that Jared Isaacman had a chance to sit down with Bloomberg Tech co-host Ed Ludlow, talk a little bit about how he is going to run NASA. Take a listen.
This goes beyond just a recommitment to the Artemis program. This is the next big leap. You know, we're not just going back to the moon under this space policy. We're declaring we're going back and we're going to establish the infrastructure. I mean, what space-loving fan out there doesn't want to see a lunar base? And then we're going to invest in the technology that's going to enable, you know, frequent long-duration missions to Mars and beyond, whether that be through nuclear propulsion or nuclear surface power, which obviously has a number of useful applications, be it the moon or Mars. So it's an exciting day. It's absolutely extraordinary national space policy. And one that I'm not surprised to see, frankly. It was under President Trump's first term that we returned American spaceflight capability to the United States after a 10-year hiatus. It's when he kicked off the Artemis program, and now, you know, we're taking it to the next level.
Administrator Isaacman, Jared, the question I get most for you right now in response to everything that's happened in the last few weeks is, how is NASA still relevant? Right, in a world where the private sector is dominating activity, it's dominating innovation. What is your answer to that question?
Well, you know, Ed, that seems to be a common misconception. I mean, you go back to the 1960s, and NASA didn't go at it alone. I mean, we had McDonnell Douglas, we had Boeing, we had Northrop. These were all critical vendors and contractors that helped us achieve the near impossible of sending American astronauts to the moon and bringing them back safely to Earth. I mean, some of these companies still exist and play a huge part in the Artemis program. And then, of course, there are some new companies, you know, like SpaceX, who's given us rapid reusability of their vehicles, and Blue Origin and Stoke. But it's the same thing. NASA is leading in the ultimate high ground of space. And let's focus a little bit more on science, too, in that. I mean, as much as I would love to see private companies and academic institutions building, you know, Hubble telescopes and James Webb Space Telescope and putting rovers on the moon, that is squarely in the responsibility of NASA. If NASA isn't out there trying to unlock the secrets of the universe, no one else is going to do it.
We are scrambling a little bit, Administrator, to react to this executive order, which has just broken at the time that you and I are speaking. Clearly, Artemis is weaved throughout it, and it is a mainstay of it. Your predecessor, who was in that role on an interim basis, reopened essentially the competitive field. So, for example, with SpaceX's human landing system, the contracts for Artemis 3, how should we expect you to approach new RFPs or any real change to those existing contracts, or will the field be open under your tenure?
Well, I think it's worth pointing out, Ed, that both SpaceX and Blue Origin already received contracts for human landing system vehicles to return American astronauts to the moon. Both organizations are putting an impressive amount of their own resources into a capability that's vitally important, and honestly, not just for a return to the moon, but their reusable heavy launch vehicles are what's going to lay the foundation for missions to Mars and beyond. I don't think it was lost on either vendor that whichever lander was available first to ensure that America achieves its strategic objectives on the moon is the one we were going to go with. So I don't think that there's a lot has actually changed in that dynamic. NASA is fortunate to have SpaceX. We're very fortunate to have Blue Origin as critical vendors. No different than Administrator Webb relied on a number of really key contractors during the 1960s.
How does this executive order change those contracts and change the approach to those projects?
Oh, I think this executive order takes things to a whole nother scale, on a whole other scale here, Ed. I mean, we're not just going back to the moon for the footsteps and planting the flag. I mean, the president calls out, we are returning to the moon. We are establishing the infrastructure to realize the scientific, economic, and national security benefits. I mean, you know, the president is no stranger to ambitious real estate endeavors. We're going to build a moon base. we're going to build a base on the moon. And not only that, we're committed to the technology that's going to take us beyond the moon. The commitment to nuclear propulsion and nuclear surface power is going to be a key enabling capability. It's going to allow us to work alongside a very healthy field of commercial contractors to set up missions for Mars and beyond. As I mentioned before, I do think this space policy is the most significant commitment to space since the Kennedy era.
And that was NASA Administrator Jared Isaacman in conversation with our own Ed Ludlow. Meanwhile, on the earnings front, Nike shares remain continuing to fall.
Yeah, actually, a second straight quarter of revenue growth, despite years and, quite frankly, quarters, we should say, of revenue declines, but not enough to boost the shares here. You see them down in the after-hours trade. Joining us right now is Bloomberg reporter Lily Meier to talk a little bit more about what's going on. The numbers on the whole were either in line or slightly above estimates, most of them here. Why do you think we're seeing such a negative reaction?
Yeah, I think the negative reaction really comes from China and from Converse. Those are the two areas that Hill really hasn't been able to turn around. So while for the most part the report is pretty happy and shows a lot of growth in some areas, it's still being dragged down.
Do you think they're going to address Converse at all? Because this has come up on past conference calls, and I feel like they've dodged that question. We have a conference call starting in about 5 minutes here, and that's been a drag for a while. They've not monetized Converse in a way that I think most investors wanted them to.
Yeah, they talked about it a little bit in the last quarter, and I'll be curious to hear what they say. They're really leaning on the Chuck Taylor, and clearly that's not enough to reshape the business. So I'm also curious to hear what's next.
Talk us through a little bit more about what we're seeing in China, because this feels like sort of an evergreen issue for Nike, never been quite able to escape that cloud. What is the current lay of the land?
Yeah, so one thing they said they really need to focus on in China is a focus on sport, which is a bigger problem for the company generally. Lean too far into lifestyle, and China is an area where they've assessed that a focus on sport would really help. So I'm curious to see in the call, what changes they want to make. They recently changed it so that the head of the China area would be reporting up to the CEO. So they're hoping that that direct line might help.
Yeah, interesting stuff there. And of course, we'll get that conference call in just under 5 minutes time. Lily, really appreciate your reporting. That is Bloomberg's Lily Meier. Nike shares now down 5.5%, Romaine.
Absolutely. Here we talk about kind of the last gasp of the earnings season. Nike and, of course, FedEx out today. Got a couple more coming in tomorrow morning. As we set you up for what to watch, what could move markets, keep an eye on names like Lamb Weston, but also in the travel space. I know you're not a cruise person, but you got to care about Carnival earnings.
Yeah, absolutely. I mean, it is a really interesting read on the consumer, on the state of travel. I know that you also aren't a cruise person, so I'm in good company here.
I like to go someplace. Like when I get on a vessel, I want to actually end up somewhere, not just like back where I started.
Fair. I like to stay home. 10 a.m. We're going to get existing home sales. Also, sentiment from the University of Michigan as well.
Once I was on a flight and I fell asleep, and apparently they had to go back to where we were because of some emergency. And I woke up as we were making our descent back into Chicago. And didn't we just leave Chicago? You didn't need to know that, but anyway, I told you anyway. You get a BOJ rate decision tomorrow as well, Katie. Stay up for that and stick around because Balance of Power is coming up at the top of the hour. Joe Matthew and company going to explain exactly what happened last night with that speech by Trump.